Welcome to Talk Tickers. Last quarter, Target actually convinced 4.4% more human beings to walk through their physical doors, and they did it all while charging full price.
Right, which is wild.
Yeah, in a retail environment where, almost everyone else is just blaming inflation for their stagnant volume, and where we keep hearing physical stores are supposedly dying.
Yeah, totally.
So how did a legacy big box retailer pull that off? That's what we're looking at today. Welcome to this deep dive.
Glad to be here.
So our mission today is to basically cut through the corporate PR spin and decode the actual strategic machinery operating behind the scenes. We are looking at Target Corporation's Q1 2026 earnings call, and we want to figure out what a massive company's financial results actually mean for you, the everyday retail investor. And we promise to distill this massive stack of earnings transcript notes into the 4 things you actually need to know in under 5 minutes. The headline numbers, the real story driving them, management's future guidance, and our ultimate bottom line on the stock. We aren't just glancing at the numbers, we're translating them into the reality of your portfolio.
It is honestly the perfect case study for this exact moment in the market. Because Target sits right at this intersection of consumer psychology, global supply chain logistics, and, cultural relevance.
Right.
When they report earnings, they aren't merely giving an update on their own corporate health. They are handing us a real-time, high-definition pulse check on the American consumer.
I like that, a pulse check.
Yeah, because the choices people make in those aisles, they tell us a lot about the broader economy.
Okay, so let's start with the scoreboard, the headline numbers. I was looking over the high-level data before we started recording, and the sheer scale is always a bit difficult to wrap my head around.
It's massive.
Right, like they pulled in $25.4 billion in net sales just for the quarter.
Yeah.
And I know the top line revenue grew, but I want to get into the specific metrics that Wall Street actually cares about. Walk me through the core growth numbers here.
So the initial number that jumps out is the 6.7% year-over-year increase in net sales.
Okay.
But as you kind of alluded to, top line revenue only tells a fraction of the story. Mm-hmm. The much more critical metric for a legacy retailer is their comparable sales.
Right, the comps.
Exactly, and those were up 5.6%.
Okay, so I always hear analysts throw around the term comps or comparable sales. For anyone new to evaluating retail stocks, why is that specific metric so much more important than just looking at total revenue?
Well, it comes down to separating actual business momentum from just, brute force expansion.
Brute force expansion? What do you mean?
Anyone with enough capital can just buy top-line revenue growth by endlessly building new stores.
Oh, sure.
You could open 100 new locations, and your overall sales would technically go up. But that masks the underlying health of the business.
Right, because you're just adding more registers, basically.
Exactly. So comparable sales, or comps, they measure the revenue generated exclusively by stores that have been open for at least a full year.
Got it.
It completely strips out that artificial temporary boost you get from grand openings.
Okay, yeah, that makes total sense. It tells you if the specific established store, in my neighborhood, is actually doing more business this year than it did last year.
Precisely. So a 5.6% increase in comps is a very strong signal that the core established engine of the company is revving, not just expanding its footprint.
Yeah.
However, even comps can be misleading in the current economic climate, which brings us to, honestly, the most vital piece of data in this entire report.
Let me guess. This is where we talk about inflation.
You know it.
Because over the last few years, I've noticed a lot of companies posting revenue growth that feels entirely like a mirage.
Yes, exactly.
They're selling the exact same amount of stuff, sometimes even less volume, right? But they are just charging 10% more for it because of inflation.
Yep.
The top line looks fantastic, but the actual volume of goods moving through the system is stagnant or shrinking. So did Target just hike prices on paper towels and call it a successful quarter?
That is the exact right question to ask. Because the entire retail sector have been leaning heavily on price realization to cover up volume declines.
Right.
But Target didn't do that here. The answer is found in that 4.4% increase in traffic you mentioned at the top of the show.
The actual foot traffic.
Yes. That metric is why this quarter is not an inflation mirage.
So that literally means 4.4% more human beings walking through the physical doors, and I assume actively checking out on the app too.
Yes. Physical and digital. And context is everything here. The chief financial officer, Jim Lee, explicitly noted on the call that this 4.4% traffic increase more than offset a 2.4% traffic decline they experienced in the same quarter a year ago.
Oh, wow. Okay.
It proves that Target isn't just relying on price hikes to extract more money from like a shrinking pool of loyalists. They're actually getting more shoppers.
Right. They're expanding the pie.
Exactly. When your overall sales go up 6.7% and your foot traffic goes up 4.4%, it means the vast majority of your growth is coming from actual organic demand. People are actively choosing Target more often.
You know, in retail, foot traffic seems like the hardest thing to fake.
Oh, absolutely.
You can play accounting games with inventory or like delay expenses, but you can't magically fabricate human beings walking into a store.
You cannot. It is the ultimate indicator of brand health. And importantly, all that traffic is translating incredibly well to their bottom line profitability.
Which we care about.
Right. So they reported earnings per share, or EPS, of $1.71. But the more illuminating operational metric is the gross margin, which actually expanded to 29%.
Okay, I saw a note about that. The 29% margin was an increase of 80 basis points from last year.
Right.
And for the uninitiated, 80 basis points means 0.8%, which, you know, might sound like absolute pennies to a casual observer.
It does sound tiny.
But when we're talking about $25.4 billion in quarterly sales,
it translates to hundreds of millions of dollars dropping straight to the bottom line.
Yeah, that's huge.
They had a massive operational victory.
Yeah.
And Jim Lee attributed this margin expansion to a few key factors, mainly productivity initiatives, supply chain leverage, and lower markdown rates.
Okay, I want to unpack the lower markdown rates piece first. To me, a markdown is just, well, a clearance sale, right?
Essentially, yeah.
So why does avoiding clearance sales have such a gigantic impact on that 29% margin?
Because the clearance rack is where retail profit goes to die.
Ah, right.
Think about the mechanics of it. When a retailer orders the wrong inventory, or simply orders too much of a good thing, it just sits on the shelf.
Collecting dust.
Exactly. It takes up valuable physical space that could be used for something that actually sells. To get rid of it, they slash the price.
Right.
Often, they have to sell it below their own cost just to physically clear the building so they can bring in new stuff.
So a lower markdown rate fundamentally means their merchandising team accurately predicted what consumers actually wanted to buy, like months in advance.
Yes.
They bought the right items, put them on the floor, and people bought them at full retail price.
That is the holy grail of retail operations. And it pairs perfectly with the second factor Lee mentioned, which is supply chain leverage.
Break that down for me. How does a supply chain provide leverage?
Okay, so think of supply chain costs as a giant fixed pie.
Okay.
You have warehouses, massive fleets of trucks, complex distribution software, and, the salaries of the logistics team.
Right, all the overhead.
Right. And those costs remain relatively static, whether you ship 10 million boxes or 12 million boxes. Because Target's traffic and overall sales volume went up, the fixed cost to move each individual item went down.
That makes total sense.
They are spreading the massive expense of their logistics network over a larger volume of goods, making every single transaction slightly more profitable.
That's a great position to be in. They also mentioned growth in some alternative revenue streams helping that margin, right? I saw something about Roundel and Target Plus Case.
Yes, those are crucial high-margin accelerators. So Roundel is their internal advertising network.
Oh, like retail media.
Exactly. Brands pay Target to place digital ads on Target.com or directly in the app. It is basically pure profit.
Yeah, margins on ads are insane.
Unbelievable margins. And then Target Plus is their third-party digital marketplace where outside vendors sell goods on Target's website.
Kind of like Amazon's third-party sellers.
Yep, same model. Both of those segments grew significantly, and they require very little physical inventory handling by Target, which naturally just pulls the overall corporate margin upward.
Right, they're not warehousing that stuff. Now, I do want to bring up one red flag I caught in the expense column, though.
Okay, let's hear it.
I was looking at their SG&A, which is selling, general, and administrative expenses, basically the day-to-day costs of running the business.
Right.
It looked like it jumped to 21.9% of sales, up from 19.3% last year. That feels like a massive spike in overhead. Did the executives address why it cost so much more to run the stores this quarter?
They did, and it is a classic accounting anomaly that you always have to watch out for as an investor.
Oh, really?
Yeah. When companies report their earnings, they have to follow GAAP, generally accepted accounting principles.
Right. The standard rules.
It is the standard rule book that ensures all public companies report their finances in a uniform way. Under GAAP rules, you have to record windfalls and settlements in the quarter they occur.
Okay, so what was the windfall here?
Last year's 19.3% SG&A figure was artificially low because it included a nearly $600 million benefit from a massive legal settlement.
Oh, wow. $600 million.
Right. It was a one-time injection of cash that technically reduced their reported operating expenses for that specific quarter under the GAAP rules.
I see. So it skewed the baseline.
Exactly. The CFO clarified that when you strip out that one-time anomaly from last year's baseline, their adjusted SG&A rate actually only increased slightly this year.
Okay, that's much less alarming.
And that slight increase was driven by highly intentional investments in store payroll to ensure better customer service and, marketing to drive that 4.4% traffic increase.
Which obviously paid off. So the core operating profitability is actually much healthier than a superficial glance at the GAAP accounting might suggest.
Definitely.
So the headline numbers are undeniably strong. Revenue is up, comparable sales are up, traffic is the star of the show, and margins are expanding because they are selling things at full price.
The financial foundation is rock solid for Q1.
But numbers do not exist in a vacuum, right? Like a spreadsheet in a corporate office in Minneapolis doesn't magically generate a 4% increase in foot traffic.
No, it doesn't.
People don't just decide to get in their cars or open the app on a Tuesday afternoon by accident. Something physical, something on the shelves or in the culture had to drag them there.
Right.
And I know they had a massive shift in their merchandising strategy. So let's get into the story behind the numbers. What exactly pulled those shoppers into Target this quarter?
To understand the mechanism driving this growth, we really have to look at Cara Sylvester, the new chief merchandising officer.
Okay.
She has essentially reorganized the entire multi-billion-dollar merchandising apparatus around one singular, hyper-focused demographic.
And who is that?
The busy family.
Okay, busy family sounds a bit like a generic marketing cliche, to be honest. Every company wants to sell to families.
Sure.
How are they treating this differently than just a standard PR talking point?
Well, they are treating it like a precise tactical military objective.
Really?
Yeah. The busy family demographic is arguably the most lucrative, yet the most stressed cohort in the entire consumer economy.
That's fair.
Think about the daily reality of this group. They are managing school drop-offs, soccer practices, dual incomes, endless meal planning, and weekend chores.
It's exhausting just hearing it.
Right. So they are highly choiceful about where they spend their extremely limited time, and they are increasingly strict about their heavily budgeted money.
Target has always been popular with suburban families, though. Like, what actually changed?
Historically, yes, they had a disproportionate wallet share. But Sylvester's new strategy is about deepening that relationship by aggressively removing friction and intentionally injecting joy into mundane errands.
Injecting joy?
And the most striking example of this execution is in the grocery department.
Actually, yeah, I noticed their grocery section looks completely different lately. It feels less like a convenience aisle and more like an actual destination. Did they share any specific data on that shift?
The volume of the overhaul is staggering. They introduced 3,000 entirely new food items in Q1 alone.
Wait, 3,000 items in a single quarter?
Yes.
Let's unpack the logistics of that. Because replacing 3,000 SKU stock keeping units, the individual barcodes for specific items, that sounds like an operational nightmare.
It is.
You don't just put 3,000 new things on a shelf. You have to remove 3,000 old things, negotiate with suppliers, change the physical store layouts, update the digital app.
It is a monumental logistical undertaking, and it carries a massive amount of risk.
Because you might make people mad.
Exactly.
Yeah.
When you remove a legacy brand from the shelf to make room for a new item, you risk alienating the customer who came in specifically for that old product.
Right. If my favorite cereal is gone, I'm annoyed.
But they took the risk as part of what they are calling their food forward strategy.
Food forward.
Historically, for a lot of shoppers, food at Target was an afterthought. You went there to buy a lamp or a t-shirt, and you remembered you needed milk, so you grabbed it. It was an add-on convenience.
Right. You didn't do your primary Sunday grocery shopping at Target.
Exactly. But the new strategy is to evolve food from a category you shop while you're at Target into the primary reason you choose to go to Target in the first place.
That's a huge pivot.
And the results validate the risk. The sales from those 3,000 new items grew more than 50% compared to the prior assortment they replaced.
Wow, that is incredible. What kind of items are they swapping in to get a 50% bump?
They are leaning heavily into high-growth, modern consumer trends.
Like what?
Like functional beverages, high-protein snacks, premium coffee, and, better-for-you meal options.
The trendy stuff.
Right. They even made a point to mention eliminating all certified synthetic colors from their own brand cereal assortment.
Oh, that's smart.
They are elevating the quality. By upgrading the grocery experience to match the aesthetic of the rest of the store, they are capturing the weekly, repetitive grocery trip.
And the brilliance of that is the cross-selling opportunity.
Oh, massive.
Once the Busy family is physically inside the store for organic protein bars and milk, they inevitably have to walk past the home goods and the apparel.
Exactly.
It's the classic Target run phenomenon. You go in for groceries and you leave with a throw pillow and a new coffee maker.
The store layout is specifically engineered to make that happen. But they aren't just relying on premium high-end groceries.
Oh, okay.
They're also executing a very aggressive value play, particularly in categories that matter emotionally to families. The prime example in this report is toys.
Toys. I saw a massive spike in toy sales. The transcript highlighted double-digit comp growth in toys.
Yes.
But what caught my attention was the price point. They specifically called out offerings priced at $20 or less, including a massive expansion of toys priced at $5 and $10.
Right.
Why is a giant retailer focusing so heavily on $5 items? I mean, the margins on those have to be razor thin.
It goes back to understanding the psychology of that busy family in the 2026 economy. Consumers are still feeling the cumulative, lingering sting of years of inflation.
Yeah, we all are.
The absolute brilliance of the $5 toy strategy is that it provides a low-stakes psychological release valve for parents.
A release valve. Walk me through how that works in the aisle.
Okay, imagine a parent who is constantly stressing over the rising cost of rent, utilities, and, auto insurance.
Right.
They have to say no to a lot of things. But when they are dragging their kid through Target to buy necessary groceries, being able to delight that child with a cool, on-trend $5 toy, it feels like a massive win.
Oh, I see.
It is a moment of spontaneous joy that doesn't ruin the weekly budget. It creates a deeply positive brand association.
That makes total sense.
It proves that Target understands that value doesn't just mean selling cheap bulk goods. It means providing affordable joy in an otherwise stressful week.
I love that concept, affordable joy. And it builds a habit. The kid wants to go to Target because they know they might get a small treat. And the parent is willing to go because they know it won't cost them $50 to appease the kid.
Exactly. And we are seeing this strategy executed across multiple channels. Yeah. It's not just happening in the physical aisles. Digital dominance is a huge part of the Q1 narrative.
Right.
You brought up the digital numbers earlier. What stood out to you?
Well, same-day delivery grew by 27%. And Target Plus, that third-party platform we touched on earlier, saw its gross merchandise volume, or GMV, jump almost 60%.
Huge numbers.
Right. Those are software company growth numbers, not legacy retail numbers.
That 60% GMV growth in Target Plus is a sleeper metric that investors absolutely must pay attention to.
Why is that?
Let's explore the mechanics of a third-party marketplace. When Target acts as a platform for other vendors, they don't buy the inventory.
Oh, right.
They don't store it in their warehouses. They don't take the markdown risk if it doesn't sell.
None of the physical risks.
None of it. They simply provide the digital storefront, process the payment, and collect a toll from the seller. It is an incredibly lucrative asset-light revenue stream that leverages the massive daily traffic of Target.com.
And what about the 27% growth in same-day delivery? How are they pulling that off logistically without bleeding cash? Because last-mile delivery is notoriously the most expensive part of e-commerce.
Oh, it's brutal. But they are turning their biggest liability, massive physical stores, into our greatest asset.
How so?
Instead of fulfilling those same-day orders from a giant warehouse 3 states away like Amazon often does, Target fulfills the vast majority of digital orders directly out of the back rooms of their existing local stores.
Oh, wow.
They are using their 2,000 retail locations as micro-fulfillment centers.
That's incredibly efficient.
It allows them to compete fiercely on convenience and speed, catering directly to the busy family that realizes at, say, 4 p.m., They need diapers and dinner ingredients before 6 p.m.
Okay, I follow the logic on the essentials. Groceries, $5 toys, fast delivery of diapers. That's the foundational stuff. That is the necessary engine of retail.
Right.
But there is another layer to this earnings report that I found absolutely wild. It's what I like to call the hype engine. Target is essentially using the sneakerhead playbook, but applying it to everyday retail.
The sneakerhead playbook is a great analogy. Let's explore how that mechanism actually functions inside a big box store.
Well, in the sneaker world, brands like Nike or Adidas will drop a highly limited edition shoe. They intentionally create artificial scarcity.
Right.
They know exactly how many people want the shoe, and they purposefully make a fraction of that amount. People line up around the block, the apps crash, the secondary market explodes. It creates a cultural frenzy.
Total FOMO.
Right. And Target is doing the exact same thing, but instead of $300 sneakers, it's exclusive collaborations. Cara Sylvester mentioned waking up to physical lines out the door before the stores even opened.
Yes, she highlighted limited drops like Roller Rabbit, Park, and an exclusive multi-category Pokemon collaboration.
They are engineering FOMO, fear of missing out. They are tricking us into doing a Target run for a limited edition Pokemon caboodle or a trendy beauty product.
It works, though.
It totally works. You get caught up in the euphoria of the hunt, you secure the limited item, and then while you're physically standing in the store, the adrenaline fades. And you realize you also need paper towels, coffee, and dog food.
It is entirely intentional. Sylvester specifically talked about celebrating the trends that shape culture to create buzzworthy assortments.
Buzzworthy.
They had 4 major launches in Q1 that drew physical lines outside of their stores. This is the strategic mechanism they use to capture market share across all income brackets.
How does hype capture different income brackets, though?
Think about it this way. A high-income consumer might not strictly need to shop at Target for value on basic groceries. They could go to a premium grocer.
Sure.
But that high-income consumer will absolutely show up at Target for an exclusive, limited edition design partnership they cannot acquire anywhere else.
The hype brings them in.
The hype brings them through the door. And once they are inside, the merchandising strategy goes to work on them. They see the elevated grocery department, the newly designed home goods section, and suddenly Target becomes part of their regular shopping rotation.
It creates this halo effect of coolness over the entire brand.
Yeah.
It makes Target feel like a cultural destination, a place where trends happen, rather than just a sterile big box where you buy laundry detergent.
Exactly. And if we want to talk about how they are securing brand loyalty over the long term, moving past the immediate hype of a weekly drop, we have to talk about the baby concierge test.
Oh, yes.
This was one of the most revealing operational details in the transcript. They were rolling this out in 200 stores.
I saw that, a dedicated concierge for baby items. How does a program like that actually function on the ground?
It operates as a high-touch, appointment-based service. Expectant parents can book time with a trained specialist.
Like a personal shopper.
Sort of, but more specialized. This concierge physically walks them through the store, helps them navigate the overwhelming complexity of building a baby registry, explains the difference between car seat safety ratings, helps them test strollers in the aisles, and advises on formula options.
Wow.
It is an intense level of personalized customer service that you typically only see in high-end luxury retail.
Why invest so heavily in payroll to hold the hands of people buying diapers? I mean, that sounds expensive.
Because of the massive shift in lifetime value, or LTV.
Ah, right.
When a couple is expecting a baby, it is a period of massive psychological vulnerability, intense anxiety, and crucially, a total resetting of their established brand loyalties and shopping habits.
Everything changes.
Everything changes. By offering a premium calming concierge service to guide terrified new parents through this overwhelming process, Target is establishing deep emotional trust at the exact moment a family's spending is about to permanently and drastically increase.
That is brilliant, because if you win the baby registry, you don't just sell them a crib one time.
Exactly. You secure the next 5 to 10 years of weekly diaper runs, toddler clothes, birthday gifts, and back-to-school supplies.
The LTV is just off the charts.
The management team actually noted a 5 percentage point acceleration in baby category comparable sales in the 200 stores that launched this test.
Wow.
The data proves the thesis. It is an absolute masterclass in customer acquisition.
So, to synthesize the entire story behind these massive Q1 numbers, They are luring the highly lucrative busy family in with an upgraded, food-forward grocery department and incredible budget-friendly value on toys.
Right.
They are making the shopping experience frictionless with micro-fulfillment, same-day delivery. They are injecting cultural hype with artificial scarcity and exclusive drops. And they are locking in generational long-term loyalty by deeply integrating themselves into the lives of new parents.
It is a remarkably cohesive, multi-layered strategy.
It is deeply impressive. But it also relies on executing thousands of tiny, complex operational details perfectly every single day across 2,000 massive stores. Which naturally brings us to the question of sustainability.
Naturally.
Let's shift our focus to the future then. Because as any retail investor knows, the stock market doesn't pay you for what you did yesterday. It pays you for what you are going to do tomorrow.
Always looking ahead.
So what is the executive suite telling Wall Street to expect for the rest of 2026?
Well, management is currently walking a very delicate tightrope in their public communications. On one side, they are definitively raising the bar based on the momentum we just discussed. Target is now projecting a full-year net sales increase centered around 4%.
Okay, and I believe that is a 2-point bump from their previous full-year estimate, right?
It is. A 200 basis point increase in full-year top-line guidance after only the first quarter is a massive signal of internal confidence.
Yeah, you don't do that unless you're sure.
Furthermore, for their bottom-line profitability, they announced they now expect EPS to hit the high end of their previously stated $7.50 to $8.50 range. So the baseline financial expectations for the company have firmly shifted upward.
You know, I'm always suspicious when executives raise guidance, but then spend half the call sounding pessimistic.
Right.
And there is a big but in this transcript. As much as they raised the numerical guidance, they spent an inordinate amount of time flashing caution signs.
They definitely did.
Michael Fidelk, the CEO, made a point to say a single good quarter has never been our goal and warned analysts about not confusing progress with potential. They clearly want to make sure the market doesn't get irrationally exuberant. So what are the specific red flags they want us to watch out for?
The first major hurdle is an internal operational comparison. Jim Lee called it the hardest comp of the year, and it is hitting right now in Q2.
Hardest comp? Why?
To understand this, we have to look back at last year. In Q2 of 2025, Target experienced a massive, unusual revenue surge driven by the launch of the Nintendo Switch 2.
The console cycle. That is a retail anomaly that distorts everything.
Precisely. When a highly anticipated video game console launches, it creates a massive, concentrated spike in high-ticket electronic sales.
Right.
But it's not just the $400 console. You have the attach rate, people buying extra controllers, carrying cases, and 3 new games. Target is now having to compare this year's regular, everyday Q2 sales against last year's massive Nintendo-fueled Q2.
It's what the industry calls lapping a major event.
Exactly. The CFO noted it is nearly a 2 percentage point difference in the baseline.
That's significant.
So a retail investor needs to be prepared. Even if the underlying core business of groceries and apparel remains perfectly healthy, the year-over-year percentage growth in Q2 might look artificially anemic simply because they cannot replicate a hardware launch event that only happens once every 7 years.
That makes sense. It's a structural comparison issue. But what about the actual living consumer environment? Because they explicitly noted that Q1 had a bit of a sugar high, which suggests some of that 4.4% traffic might not be sustainable.
Yes, the phrase sugar high is very revealing. Management believes that this year's higher tax refunds provided a temporary exogenous boost to consumer spending in the first quarter.
Right.
People got their checks from the IRS, felt a little flush with unexpected cash, and maybe upgraded their weekly Target run. They bought a slightly nicer coffee maker or splurged on that Roller Rabbit collaboration.
But tax refunds are a one-time seasonal injection. That financial tailwind will not exist in the back half of the year when families are gearing up for back to school or holiday shopping.
Correct. And right alongside that fading tailwind, management pointedly mentioned a recent measurable dip in overall macroeconomic consumer sentiment.
We hear about consumer sentiment constantly. Are there specific indicators they are watching that are making them nervous?
They're looking at the foundational health of the household balance sheet. For years, consumers have been remarkably resilient, absorbing cumulative price shocks across food, housing, and energy.
It's been tough out there.
But the cracks are forming. The average household savings rate is dwindling back to historical lows, and credit card balances are rising significantly.
Oh, that's not good.
Target's management is acknowledging the reality that the consumer might simply be exhausted. They are deliberately maintaining a cautious outlook because they recognize that the broader economic weather could change rapidly. And discretionary spending is always the first thing to get cut when a family budget tightens.
So if you are a retail executive and you see those dark clouds on the macroeconomic horizon, how do you operationally prepare your 2,000 stores for that caution?
You defend your business through rigorous inventory management. Michael Fidel made a fantastic revealing point on the call regarding their current philosophy.
What did he say?
He stated, "We like our business model when we're needing to chase inventory in the face of stronger than planned sales, much more than when we find ourselves needing to cancel purchase orders or mark down excess inventory."
Let's unpack the mechanics of that, because I think that single sentence is the absolute essence of retail risk management.
It really is.
He is saying it is operationally better to slightly underorder goods and run the risk of selling out of an item than to overorder and be stuck with a warehouse full of unsold product.
That is the core philosophy of an inventory chase model. Let's look at the two scenarios. If you underorder and consumer demand turns out to be incredibly strong, yes, you miss out on some incremental top-line sales because the shelf is empty.
Right.
But your margins remain incredibly high because you sell every single item you have at full retail price. Plus, you inadvertently create a sense of scarcity, which feeds right back into that hype engine we discussed.
But the alternative is catastrophic.
The alternative is the bullwhip effect we saw across the retail sector in 2022.
Oh, I remember that.
If you overorder because you are overly optimistic and consumer demand suddenly drops, you destroy your margins. You have to run massive clearance sales to get rid of the goods. You clog up your entire physical supply chain with stagnant pallets, and you tie up billions of dollars of cash in unproductive assets.
So Target is actively choosing a defensive, highly lean inventory posture to protect their profitability against a potential consumer slowdown.
Exactly.
That strategy makes total sense in theory, but it requires incredible agility to actually execute.
It does.
Like, if an item suddenly goes viral on social media and you underordered it, how fast can you actually restock a physical store? I saw Lisa Roth, the new COO, highlighted a bunch of massive investments they are making in their supply chain. Are they building the infrastructure to react that fast?
They are overhauling the entire network to enable that exact speed. Roth detailed a new receiving center in Houston that is designed to process 25 million cartons annually.
25 million.
Yeah. They just opened a specialized new food distribution center in Colorado to handle that massive influx of 3,000 new grocery items. They even brought in a new chief global supply chain officer, Jeff England, to orchestrate it all.
It sounds like they're trying to build a supply chain that acts more like a nervous system.
That is the goal. They want a network designed to be agile, to chase inventory quickly when a data spots a trend, rather than blindly placing massive bets with overseas manufacturers 6 months in advance.
Right.
If you can read the point of sale data, spot that a specific $10 toy or a new functional beverage is accelerating in velocity, and use your regional upstream facilities to surge that product to your stores in a matter of days, you don't need to carry massive risky stockpiles in the backroom.
You use data and logistical speed as your competitive moat?
Exactly.
Well, we have covered a massive amount of ground here. We've dissected the 6.7% revenue growth and the 4.4% traffic surge. We've explored the cultural merchandising strategy targeting the busy family, from $5 toys to the baby concierge.
Yep.
And we've weighed management's upgraded guidance against their extremely cautious inventory posture. It is time to render a verdict. We've got all this data and strategic analysis. What does it actually mean for you, the listener, who is currently holding Target stock in your portfolio, or perhaps sitting on some cash and considering buying in? Where do you stand?
Based on the underlying mechanics revealed in this quarter's readout, I take a definitively bullish stance on Target over the long term.
Bullish. Okay, lay out the actionable case. Why are they a buy?
The primary reason is that the mechanics of their multi-year turnaround are officially measurably working. And we know they are working because the top-line growth is being driven by actual human foot traffic and digital engagement, not just by inflationary price hikes.
Right.
I cannot overstate how important that distinction is. When a retailer has to rely on relentlessly raising prices to grow revenue while their foot traffic drops, they're standing on a melting iceberg.
That's a great image.
Eventually, the consumer breaks and stops coming. But when you are growing, because more people are actively choosing to walk through your doors more often, you are building on bedrock. It sets a sustainable compounding foundation for future growth.
It's the difference between extracting more value from a shrinking pool of captured loyalists versus expanding the total pool of customers entirely.
Precisely. The second reason I am bullish is how aggressively management is self-funding their own future dominance. They announced they are deploying $5 billion in capital expenditures CapEx this year alone.
$5 billion. Where does that kind of cash actually go?
It goes into physical dominance. They are opening 30 new, significantly larger format stores designed specifically to hold more grocery and backroom fulfillment space.
For the same-day delivery stuff.
Right. They have over 100 massive store remodels currently underway. They are pouring cash into the new supply chain nodes in Houston and Colorado. They aren't just resting on the laurels of a surprisingly good Q1 and paying it all out in dividends. They are pouring the profits right back into the engine to permanently widen the gap between them and their competitors.
And doing all of that while maintaining the disciplined, lean inventory posture that protects their 29% growth margin from clearance sales.
Yes. For a retail investor evaluating the sector, this report is a textbook example of a company successfully defining and defending its economic moat.
Right.
Target knows it cannot compete with Amazon on infinite digital selection and next-hour delivery. And they know they cannot compete with Walmart on absolute rock-bottom deflationary pricing across every single grocery item.
Yeah, that's a losing battle.
If Target tries to fight a war of attrition on either of those fronts, they will inevitably lose.
So what exactly is their moat then? If they can't be the cheapest and they can't have the most stuff, why do they win?
Their moat is curation, elevated design, and the affordable joy we discussed. Their moat is making the mundane chore of weekly shopping feel slightly aspirational, aesthetically pleasing, and culturally relevant.
It's a vibe.
Exactly. By leaning heavily into exclusive brand partnerships, completely revamping the visual merchandising of their home and beauty departments, and turning the dreaded grocery run into a moment of potential discovery, they are reinforcing the exact unique value proposition that protects them from the cold algorithms of Amazon and the sheer utilitarian scale of Walmart.
Yeah.
They know exactly who they are as a brand, and more importantly, they know exactly who their customer is. It is that stressed, choiceful, busy family. And they are executing flawlessly against the specific psychological and practical needs of that demographic.
I think that is the perfect encapsulation. They are playing their own game on their own board, and they are winning it. And that brings us to the end of our analysis today. We have torn through the headline numbers, the merchandising mechanics, the supply chain risks, and the long-term investment thesis. Thank you for joining us on this deep dive. We hope you feel significantly more informed about the retail landscape, equipped to see through the numbers, and ready to make smart, data-driven decisions for your portfolio.
But before we sign off, I want to leave you with one final provocative thought to ponder as you evaluate your investments in this space.
Let's hear it.
Target is currently seeing mid-single-digit growth by capturing this busy family demographic with affordable trends, $5 toys, and clever cultural partnerships. But with a multi-year, multi-billion-dollar overhaul of their physical footprint and supply chain just getting started, are we simply witnessing a temporary post-inflation rebound fueled by a few good quarters? Or are we actually watching the early stages of Target permanently redefining the American retail hierarchy, carving out a cultural fortress against giants like Walmart and Amazon that simply cannot be breached?
That is the ultimate question for the long-term investor. Is this a momentary operational victory, or is this the foundation of a new retail dynasty? Think on that the next time you find yourself wandering the brightly lit aisles with a red cart, somehow buying 3 things you didn't even know you needed until you saw them on an end cap. Until next time, keep looking past the spin.